Hi, my name is Fatima Zahra, an expert tutor in financial reporting, presenting to you this topic explainer video on impairments of assets. This video will cover how this topic is examined, how to prepare for this topic with reference to the ACCA study materials. It provides a brief overview of some of the most important concepts within this topic together with illustrative examples, namely impairments of an individual asset, impairments of a CGU, impairment reversals, and the presentation and disclosure of impairment losses. Lastly, please note, this video is not a reteach of the topic and you are required to make sure you cover all the approved content for this topic. According to the FR syllabus, impairments of assets feature under transactions in financial statements at an intellectual level too. So this topic is tested both in objective test questions and constructed response questions. For constructed response questions, students would be required to calculate impairment losses, which could involve some complex number crunching and then correctly disclosing the losses in the financial statements. It should be noted that this topic is highly integrated with IAS 16, Property, Plant and Equipment, and IAS 38, Intangible Assets, and you must be extremely familiar with the revaluation model before you begin this video. In order to prepare yourself adequately, it will be useful to use the following approach. Make sure you are familiar with the technical content. This section can be tricky, so you would need to spend sufficient time to get familiar with the underlying principles. Thankfully, ACCA has some great material to help you with this. Please make sure you use the technical articles and the above Study Hub resources to consolidate your knowledge. Once you are familiar with the technical content, you then need to do exam preparation. Since you are writing a computer-based exam, you must be familiar with the CBE tool, which can be found on the practice platform. Please make sure you do sufficient exam questions on this topic. Additionally, the Study Hub has a wide range of practice questions on this topic, which include objective test questions and constructed response questions, which are a great way to test your knowledge on the topic. In my experience, common mistakes that students make in this section include students getting confused with the many different dates and amounts in the scenario. So students should always make use of a timeline of events in their workings. Students not showing the marker their thought process by omitting their workings or not having proper references to their workings, and incorrectly disclosing impairment losses in the financial statements between profit and loss and other comprehensive income. Now let us begin. The following terminologies are imperative for you to understand before we move on. You may pause the video now to ensure you are comfortable with these terms if you are already not. Let us zoom into the definition of an impairment loss. The IFRS accounting standard, IAS 36, defines an impairment loss as the amount by which the carrying amount of an asset or CGU exceeds its recoverable amount. But how does one establish if the carrying amount of an asset or CGU does exceed its recoverable amount? According to the standard, for most assets or CGUs, an entity should establish at each reporting period whether there is any indication that an asset may be impaired. Should an indication exist, then the entity shall estimate the recoverable amount of the asset, and the amount that the carrying amount exceeds the recoverable amount will be regarded as an impairment loss if applicable. Now, in order to establish at each reporting period whether there is any indication that an asset may be impaired, the standard mentions a list of both external and internal indicators of impairments that you should be familiar with. In essence, an impairment indicator is any evidence to suggest that the future economic benefits associated with that asset or CGU has declined. Let us make it real. Do you recall the definition of an asset? An asset is a resource that has future economic benefits. Now let us say we have a soap machine that has a carrying amount of $6,000 at reporting date. The machine will be utilized to produce soaps. The entity is expected to generate profits from selling these soaps, and the profits will be shown to users in the Statement of Comprehensive Income. So for this asset, its future economic benefits of $6,000 is expected to be derived from manufacturing and then selling these soaps. Now let us say a storm had to physically damage key components of the machine permanently, whereby the machine now only functions at 60% of its original functionality. Production of the soap would decrease by 40%, and the profits generated by selling the soaps would also decrease by 40%. Therefore, the future economic benefits associated with the soap machine have declined. The physical damage to the machine due to the storm would be regarded as an impairment indicator. At this point, the entity is required to estimate the machine's recoverable amount, which is the higher of the value in use or fair value less cost to sell. In this instance, the value in use of $3,600 is higher than the fair value less cost to sell of $3,000. So the recoverable amount would be $3,600. Now, since the carrying amount of $6,000 exceeds the recoverable amount of $3,600, an impairment loss of $2,400 exists. An impairment loss would need to be recorded. The machine will no longer be recorded at $6,000, but rather at its recoverable amount. This is to correctly show the future economic benefits associated with the machine after the machine had been damaged and its production capacity has been reduced. Now that we have a basic understanding of what an impairment is, let us look at the general process of individual assets and CGUs. As previously mentioned, an entity should establish at each reporting period whether there is any indication that an individual asset may be impaired. Should an indication exist, the entity shall estimate the recoverable amount of the asset, and should the carrying amount of the individual asset exceed its recoverable amount, the asset should be impaired. However, calculating a recoverable amount for an individual asset may not always be possible, and if this is the case, the asset should be impaired as part of a CGU. We will cover this shortly. We have already covered most principles regarding an impairment of an individual asset when discussing the soap machine, so now we will cover a few more pertinent concepts. To recap, an impairment loss of an individual asset is the carrying amount of that asset less that asset's recoverable amount. But where is the impairment loss recorded? The general principle would be recognizing the impairment loss immediately in profit and loss, unless the asset is carried at a revalued amount. If that is the case, the impairment loss is treated as a revaluation decrease. Let us look at this example of three different assets. For all three assets, the carrying amounts exceed the recoverable amounts by $10,000. Therefore, the impairment loss for each asset is $10,000. Asset A is measured on the cost model, so there is no revaluation reserve relating to it. Asset B is measured on the revaluation model and has a revaluation reserve which is equal to its impairment loss. Asset C is measured on the revaluation model as well, but its impairment loss exceeds the balance of its revaluation reserve. So since asset A has no revaluation reserve, the entire impairment loss of $10,000 will be recognized as an expense in profit and loss, and the value of the asset will be reduced by the impairment loss amount. For asset B, since the asset has a related revaluation reserve, the impairment loss of $10,000 will first need to decrease the revaluation reserve prior to an expense being recognized in profit and loss. Since the entire revaluation reserve equals to the impairment loss, The entire $10,000 of the impairment loss will be recorded as a reduction of the revaluation reserve, bringing it to zero, and the value of the asset will be reduced by this impairment loss amount. Again, in this case, since the asset has a related revaluation reserve, the impairment loss of $10,000 will first need to reduce the revaluation reserve prior to an expense being recognized in profit and loss. Since the revaluation reserve amounts to only $4,000, $4,000 of the impairment will be recorded as a reduction of the revaluation reserve, bringing it to zero, and the remainder $6,000 will be recorded as an impairment expense in profit and loss. The value of the asset will be reduced by the impairment loss amount. As you can see in this case, part of the impairment loss is recorded in OCI and part is recorded in profit and loss. Now let us look at a situation where a recoverable amount cannot be calculated for an individual asset. Now in this case, the standard then requires the entity to determine the recoverable amount of the cash generating unit to which the asset belongs to. Let us look deeper into the definition of a CGU. A CGU is the smallest identifiable group of assets which generate cash inflows that are largely independent of the cash flows from other assets or groups of assets. For example, a mining entity owns a private railway to support its mining activities. Now, if there was an impairment indicator to this railway system, it would not be possible to estimate the railway system's recoverable amount since it does not generate cash flows which are independent from the mining activities. Think about it. The mining company would not be able to generate cash flows from this railway system by transporting passengers or unrelated cargo to a private mining site. Therefore, the recoverable amount of the entire mine as a whole would need to be estimated in order to calculate the impairment loss. Calculating the impairment loss of the CGU would be the carrying amount of the CGU less the recoverable amount of that CGU. However, when allocating an impairment loss to a CGU, there are specific steps an entity needs to follow. Should a CGU contain goodwill, then the impairment loss should first reduce the value of goodwill. Thereafter, the remaining impairment loss should be allocated pro rata to the remaining assets. If a CGU does not contain goodwill, then the impairment loss is simply allocated pro rata to the assets within the CGU. However, it should be noted each asset cannot be reduced to the higher of the asset's fair value less cost to sell, value in use, or zero. Let us look at an example of an impairment to a CGU. As a result of adverse publicity, Fingal has a recoverable amount of only $200,000. The net assets of Fingal, a cash-generating unit, are as follows. The CGU contains property, plant and equipment, goodwill, a product patent, and the net current assets with its corresponding values. The impairment loss of this CGU would be $100,000. This is taking into account the carrying amount of the CGU of $300,000 less its recoverable amount of $200,000. Now, since this CGU contains goodwill, we must follow the two-step approach. Step 1 would be to reduce the value of goodwill. In this instance, the impairment loss of $100,000 must first reduce the goodwill balance of $50,000. The remaining impairment loss to be allocated pro rata to the rest of the assets in the CGU would be $50,000, which is the total impairment loss less the amount allocated to the goodwill. Step 2. The remaining impairment loss of $50,000 is allocated pro rata to the property, plant and equipment and the product patent in the CGU. You would first need to calculate the ratio of these assets in relation to each other. As you can see, the ratios are 91% and 9%. You would then need to multiply the remaining impairment loss of $50,000 to these ratios. Now, as you can see, the carrying amount of the CGU after allocating the impairment is reflected at its recoverable amount. Now that we have covered impairments of assets, let us look at reversals of impairments. Now, if an asset is impaired, the standard prescribes that for that asset, at each reporting period, an assessment needs to be made if an indicator exists to reverse or decrease the previous impairment. Should an indicator exist, the recoverable amount of that asset must be calculated, and should that recoverable amount be greater than the carrying amount of the asset, an impairment must be reversed. However, the effect of this reversal should not increase the carrying amount of the asset to a value higher than the carrying amount had no impairment taken place, as essentially that would be a revaluation to the asset. Let us look at this example on an impairment reversal. An asset is impaired 2 years after being in use. Then 2 years later, an impairment reversal is evident and we are required to calculate the amount of this impairment reversal. There are many different dates and amounts in this scenario which can be confusing, so for this reason, I will transcribe the important information on a timeline of events. When dealing with an impairment reversal question in an exam, step 1 should be to calculate the carrying amount of the asset had no impairment taken place at the date of the impairment reversal. What does this mean? It simply means to calculate the carrying amount of the asset ignoring any effect of impairments to that asset. In 20x8, the asset has been in use for 4 years out of the 5 years, so the carrying amount would be $2,000. This is a basic calculation using your knowledge from IAS 16, Property, Plant and Equipment. Step 2 would be to calculate the impairment reversal, which is simply the new recoverable amount less the carrying amount taking into consideration the impairment loss. In this example, all these amounts have been given, so the impairment loss at this stage is $3,667. Step 3 is to apply the cap. Remember, the asset cannot be recorded at an amount greater than the carrying amount had no impairment taken place. In this instance, the recoverable amount is greater than the carrying amount had no impairment taken place, so the cap applies. This means the entire impairment reversal of $3,667, which we previously calculated, cannot be recognized. The only portion of the impairment reversal that can be recognized would thus be the capped $2,000 less the carrying amount of the asset, which takes into consideration the impairment. Now let us examine how impairment losses and reversals will be presented and disclosed. In an FR exam question, you may be required to prepare a statement of profit and loss in which you categorize income and expenses correctly, or you may be required to identify within which category a specific item of income or expense is presented. IFRS 18 suggests that certain items may require disaggregation either in the primary financial statements or the notes. This is either because they have dissimilar characteristics to other items or because the resulting information is material. One of these items is impairment losses and reversals of PPE. In an exam, you may be required to disaggregate impairment losses and reversals of PPE from other expenses. If this is the case, it will be made clear in the question. For the FR syllabus, practically, IAS 36 impairments relating to PPE and impairments to goodwill which arise from a business combination will be presented in the operating category. However, some IAS 36 impairments can be categorized in the investing category. An example of this would be impairments to investment properties. In the operating category, impairments of an entity should be presented either by nature or by function in a way that provides the most useful structured summary of those expenses. These are typical examples of how impairments could be disclosed according to nature or function. In the FR exam, you may be asked to classify operating expenses either by nature or by function. This will be made clear in the question. It should be further noted that IFRS 18 requires companies that present expenses classified by function to disclose in the notes the amount of impairment losses in each line item in the operating category of the statement of profit and loss. This brings us to the end of this topic explainer video on impairments of assets. I hope you found this video useful. Good luck.